Hello everyone, today I'm doing the second video submission in the Accounting 01. So for first question, and the answer is a journal entry is used to record a business transaction in the accounting records of a business. An account is a record or statement of a financial expenditure and the receipt relate to a particular period or purpose. Ledger is a book or a particular type, and posting accounting is when the balance in subledger and the general journal are shifted into the general ledger, and the trail balance is a booking keep worksheet in which the balance of all ledger are complete into debit and credit account column total that are equal, and adjusting entries are usually made on the last day of an accounting period, year, quarter, or month, so that a company's financial statement complete with the accrual method of the accounting. And closing entries are those general entries made in the manual accounting system at the end of an accounting period to shift the balance in temporary account to the permanent accounts. For second question, accounting equation is a basic principle of accounting and the fundamental element of the balance sheet. The equation is as follows: as equal to liabilities plus the shareholders' equity. And for third question, for first step of accounting cycle is a collection of data and analysis of transactions. In the first step is the account of the company, collect the data and analyze the transactions. And for step two, journalizing after collecting and analyze the transaction, it's time to record the entries into the first book of accounts. Recording the entries in the journals is important since if there are any errors at this stage of recording, it will linear on in the next books of accounts as well. For step 3 is recording the journals into the ledger accounts. After the journalizing of the transaction, it's time for the account to record the interest into the secondary books of accounts. If there are cash and capital, there will be two tables in the general ledger, and then the balance of the respective account will be transferred. For step 4, creating the adjusted trail balance from the closing balance of the general ledger accounts. An adjusted trail balance is prepared. In this trail balance, the debit balance will be recorded on the debit side, and the credit balance will be recorded on the credit side. And for step 5, performing adjusting entries. The adjusting entries are typically related to the accrual adjustments and periodical the depreciation adjustment or amortization adjustment. And for step 6 is creating the adjusted trail balance. This trail balance is called the adjusted trail balance since it is prepared after the adjustment the interests are passed, and as a result, this trail balance can be used to prepare the most important financial statement. For step 7, creating financial statement from the trail balance. This step of the accounting cycle is the most critical part. These are the four most important financial statements that are prepared using the adjusted trail balance, like the income statement, the balance sheet, shareholders' equity statement, and the cash flow statement. And first step 8 is closing the books. So closing books means that all financial statements are prepared and all transactions have been recorded, analyzed, summarized, and record. And for the final step is creating the posting closing trail balance. All the accounts are taken into the account, and then the closing balance are recorded as a peer their respective positions. Then the credit side and the debit side are being matched to see whether everything is the right order or not. And for last question, accrual occurs before a payment or receipt, and the deferral occurs after payment or receipt. These are generally related to the revenue and the expenditure largely.